Let's go.
Hello, everyone, and welcome to Zephyr's Adjusted for Risk podcast from the shores of Lake Tahoe. Today is going to be another fantastic episode as we focus on investing in distressed debt with a leader in the distressed debt space. But first, today's episode is sponsored by the award-winning Zephyr, which helps investment professionals make more informed investment decisions. I'd like to welcome George Schultze. George is the founder of Schultze Asset Management. George, thank you so much for coming on the show. It's an honor to have you on, so thank you.
Thanks, Ryan. It's great to be here.
Please tell us a little bit more about yourself and Schultze Asset Management?
Sure. Yeah, Schultze Asset Management is a firm I founded about 25 years ago, a little over 25 years now. It's been, this is our 26th anniversary, actually. We've invested $7.5 billion since inception, and our firm focuses on event-driven and distressed securities investing. My background is I'm from the tri-state area in New York. I was born and raised in New Jersey. Actually, my parents were immigrants. My dad originally came from Germany, born and raised there. My mother was born and raised in Mexico. So I am trilingual, speak English, Spanish, and German. Being a Rutgers native, I went to Rutgers College and earned degrees in finance and political science there. Earned my BA there, graduated in '92. And then I went on to law school. Okay. I went to Columbia Law School in Manhattan, got a JD there, and also got an MBA from the business school right next door. By the way, it's crazy to see what's happening in the campus there the last couple of weeks. But graduating from law school and business school, then moving on, I did a brief stint at Merrill Lynch. Okay. Also worked briefly at a major New York-based law firm, Mayer Brown, and then spent a little bit more time with a firm called MD SAS, which is a distressed investing specialist before putting out my own shingle and starting my own firm in 1998. So I live in Westchester County, New York, in Rye, New York. Okay. I have 6 kids, and I love doing a number of sports. I know you're in Lake Tahoe. I love skiing, but I also love golf and kiteboarding and playing squash and chess as well. So it's a little bit of background on me.
And that is fantastic. First of all, Rutgers, I am a huge Wisconsin Badger fan. So Big Ten rivals here. I won't hold anything against you during this conversation. We can talk Rutgers and Big Ten sports later, but it's interesting you're from Rutgers. And yes, skiing, we do a lot of that, and kiteboarding is interesting. There is some of that out here in the lake also.
So, I didn't know that. That must be great. One day I'll have to try that there. But I hear the water is a little bit chilly there.
Yes, it does. It never warms up. It's so huge, so deep. It's like it's the second deepest lake in the U.S. behind Crater Lake up in Oregon. It just doesn't get warm. It's always like 55 degrees or something. So yeah.
Wow. Maybe ice fishing is more appropriate. We'll see.
Yeah, exactly. And being from Wisconsin, I'll take you ice fishing. I'll take you ice fishing out here.
Love it.
Let's start at the top. And many people probably already know this, but let's just start with, what is distressed investing?
But distressed investing, when investors or clients or prospects ask us here at Schultze Asset Management, one way we like to describe it, just kind of simply, is that it's an opportunity to invest in an arbitrage situation. Okay. And the arbitrage is this: an arbitrage is an opportunity to make money really by taking less risk than a typical investment. Sometimes it's riskless, actually. But investing in distressed securities means buying distressed debt at pennies on the dollar, and through that type of investment, getting ownership in the underlying business, getting equity ownership in the underlying business at an attractive price because of things that are happening in the debt market. So it's kind of like an arbitrage opportunity. You're buying distressed debt to get equity ownership, but you buy that debt at a time when the existing owners of the debt no longer have an appetite to own it. They become forced sellers. And It can be for whatever reason. People say it's because of there's blood in the streets or, something bad has happened. But generally, it occurs when your traditional debt investors can no longer own that debt because it's either stopped paying in par on maturity or is otherwise forced to restructure, maybe even go through bankruptcy or suffer some sort of major credit rating downgrade. So that's what it is at a high level. I hope that you know is that clear. Makes that clear. Be happy to spend a little bit more time describing it more if you have questions about it.
That's perfect. That's perfect. We have a lot to talk about. In the future, I'd love to have you on, maybe get really in deep into the strategies and so on. Um, is it hard to find opportunity? The economy, while it's slowing and it's still growing, is it hard to find opportunities right now in the distress space?
Um, it's very interesting, and one of the things that's cool about doing distressed investing is because to do it right, it's important to have a good sense for what's going on in the economy. And right now, the economy is going through big change in the US. GDP is about 3%, but you still have inflation at a pretty high level. CPI, the last reading was 3.5%. Unemployment remains very low at under 4%, 3.9%. The biggest change is that interest rates have climbed, incredibly over the last 2 years. And then looking backwards, before that, interest rates had gotten down to the lowest they'd ever been, think in the history of the financial world, going back thousands of years, I've read. So interest rates got to zero. Now they've climbed to a more normalized rate for the Fed funds rate or the policy rate, whatever you want to call it, the riskless U.S. Government rate. It's about 5.375. So we're in an environment now where the economic picture is changing once again, and more companies that issue too much debt are facing challenges repaying that debt. So the answer, in a word, is no. It's incredibly easy to find new distressed opportunities now. They're coming at us from all sorts of different corners of the market.
Interesting. So I'm glad you brought up interest rates. That was my next question. The volatility of interest rates has never been higher, at least in recent memory, like you talked about. How does that impact distressed debt markets? It sounds like it provides more opportunity for investors.
It does. And one way to think of it is, the amount of distress outstanding, it sort of follows the business cycle. And usually when economists think about the business cycle, it's a 6 to 8 year cycle, for most economies, not just the US, but for most economies, between growth and eventually, slowing down and sometimes even getting into a recession before the next cycle starting. And a lot of that is a driver, a lot of that cycle, the business economy and the economic cycle is a driver of interest rates also because the Fed's job is to try to maximize growth and minimize unemployment while maintaining price stability. So the Fed uses as one of its tools in its our quiver of arrows, interest rate policy to try to manage a bit of a stable economy. And generally it works well, but when interest rates move up a lot, especially after extended periods of being low, that's when you see a lot more distress. So we're in that kind of environment right now. The default rate has really started to increase. The long-term average default rate is about 3.5%. And you might ask what default rate means, but that's most people that are focused on this sector think of it as the percentage of total debt outstanding that's in distress or in default. And most people that look at it also, most economists that track this market tend to focus on junk rated loans and bonds, but you can take a wider approach and include both investment grade and junk rated bonds as you think about the default rate. But again, I guess to summarize, the default rate tends to climb and drop with interest rates, and both of those tend to climb and drop with the economic cycle.
Interesting. So yeah, I mean, interest rates drive a lot in the economy, and it's like every day we're talking about interest rates and the 10-year yield, and it fluctuates. like I said, the volatility there, I don't know if it's ever been higher. And because of that, a lot has been made about fallen angels, and you kind of touched on it, downgrades and companies that have to borrow again or refinance their debt at higher rates. A lot has been made about fallen angels during this rate hiking cycle. Are these the type of companies you are looking for also?
Sure, we'll look at fallen angels. I mean, it's not our main focus, but I would say just generally, given that interest rate policy and changes of interest rates can make such a big difference in the economy and also for highly leveraged companies. Um, it's really a challenging time right now, if you think about it, for companies, because not only are you seeing higher inflation and a slowing economy. I mean, let's face it, the economy is still doing okay, but it's slowing from where it was a year or two ago. Um, so you have inflation that sort of impacts every business in one way or another, whether it's higher labor costs or higher costs of raw materials, et cetera. But now with higher interest rates, you also have much higher interest expense. And so for companies that are fallen angels, most people define those as previously investment grade companies that fell on bad times and therefore became junk rated or had a lower credit rating issued to them because things got worse. I think it's a growing universe for sure, and there'll be more and more of those companies. But clearly, it's a time where you're entering a massive new distress cycle. And frankly, if you're nimble and have a flexible investment strategy within distressed securities investing, you can take advantage of that because you don't have to just buy long distressed debt. You could also short sell stocks of companies issued by companies that look like they're in trouble or they're over levered or they just don't have the flexibility, to go through a full business cycle. Um, there's some other interesting stuff going on in distressed debt in terms of secular change. Let me leave it at that, to see if you have any follow-up thoughts or questions about it.
Yeah, you brought up short selling real quickly. And during the pandemic, and there's that short squeeze on, some of these names and fear missing out. Does that play into your mind now that, there's this retail investment group that they're trying to, punish short sellers and which is short squeezes and stuff like that? Does that come into mind when you're short selling a company?
Well, good question, Ron. You certainly shouldn't ignore that kind of thing. Having done this for over 25 years, I mean, I've seen all sorts of environments like that. They used to just call them short squeezes, but lately they took on a new name, meme stocks and things like that, whether it was AMC Entertainment or Hertz, Yellow Corporation. Sometimes you get companies that are effectively dead, where the outlook is so terrible that it's very clear that they're either going to go bankrupt or maybe they're already in bankruptcy, and yet the stock climbs. And frankly, I think the main reason for it is just supply and demand, which is temporary. You can get a company like that where the stock is, borrowed by so many investors to short sell that the supply, causes trouble. It causes technical trouble and thereby excess demand when it goes up. And that itself, the demand to cover those shorts causes the price to climb, sometimes extraordinarily, like you saw with AMC Entertainment when that cinema company went through or entered COVID. You had a giant rally in the equity, and ultimately that was very unique, by the way, that company issued new equity through ATM secondary stock market issuances while the stock had appreciated so much. A lot of companies don't do that, or they're not able to do it. Maybe they have a temporary freeze in terms of ability to issue new shares for whatever reason. Maybe they have material information that they haven't disclosed to the market yet. Um, but most of the time, when companies go bankrupt, and certainly when they're in bankruptcy, the likelihood of equity holders or stockholders getting anything is so low for U.S. companies that these short squeezes, if you can stand through them or you can sit through them and have the flexibility in your portfolio to see them through, eventually they tend to go to zero. Or probably better, to reduce risk, it's probably best to cover those kinds of things or avoid them altogether and focus on those companies that aren't so heavily shorted that they have a very high cost of borrow and risk of that kind of rally. Um,
Mhm.
Having said all that, it still makes sense to short sell companies facing risk of bankruptcy because these are very unique and low likelihood outcomes where you get like a meme stock rally or a short squeeze like that. More often, and it doesn't get reported as much because it's maybe not that interesting, but more often, when companies go bankrupt, their stocks go to zero.
Right. Interesting. You have mentioned that it's a great opportunity in distressed debt. Why is that? I think I might know the answer based on your comments earlier, but why? What is driving this great opportunity?
Well, it is the climb in interest rates. You had so many companies issue so much debt across so many different sectors that now you have these non-natural equity holders, and they're equity holders in drag. They're really invested through the debt market, and they were so desperate to get yield, and so because of that, their underwriting standards went out the window, and they issued debt to companies that really shouldn't have borrowed that much at the height of the credit boom. And so now, so many of those companies are going to go through bankruptcy, and it's across virtually every industry. One
Mhm.
industry that's really seeing a lot of trouble right now is commercial real estate.
Yeah.
And it's interesting because you have secular change where more and more people are working remotely, so there's less demand for office space. But then also you have, extremely highly levered capital structures to buy that previously were levered to buy offices, and now also higher interest rates.
Mhm.
So you have like the worst of all worlds, and another thing that sort of leads from that is with commercial real estate facing so much risk of distress, then banks and lenders to commercial real estate, offices are also distressed. And we saw that last year. We saw a big, sort of hint of it when all these regional lenders failed last year, whether it was, Silicon Valley Bank, First Republic Bank, and even Credit Suisse. You had, major bank failures last year. So there is risk that all these changes can create like systemic trouble in the economy. But for now, those are two spaces, the finance space, the banking space, commercial real estate. But there are other sectors too, like for instance, telecom and healthcare and industrials, almost every sector in the economy is facing risk of more distress because of the interest rate change, but also because of inflation and a slowing economy. I think maybe, lots of investors don't realize also that we still have an inverted yield curve, which is a really good predictor of future risk of recession in an economy. And, a lot of economists are expecting that we might have a recession as soon as by the end of this year still. So taken together, all those things are presenting us what I think is going to be one of the biggest distress cycles we've ever seen.
Wow. Interesting. What are some risks to investing in distressed debt then?
So it's a very unique strategy. It certainly requires expertise. It's not something you should try at home, right? If you do want to dabble in distressed investing, you should really work with an experienced investment manager who's been able to, understand this sector and has, proven a track record of experience with all sorts of different deals, whether it's long or short. I mean, you mentioned short squeezes earlier. That's one thing that can go wrong, but also generally distressed debt investing requires patience.
Okay.
You can have, liquidity dry up, if you're invested in one of these loans or bonds, and it may take several months or several quarters or even years to work that out. Sometimes in exchange for your old loans or bonds, you're issued new equity, and the new equity might not be publicly traded. Or it might trade in the, as they say, the expert networks, because it might be listed, but it's OTC and not on one of the major exchanges. So then it really helps to have the expertise because then you'll know the market makers and you can still, buy or sell that security. But you can't necessarily do it if you're a retail investor. So there are lots of things to look out for, lots of potential landmines in the distressed debt space. So I think experience is key. One other thing in this cycle that's a little bit different from prior cycles is that there's more intercreditor violence. And by that, I mean lawsuits or claims between different sets of creditors for different debt or bond issues in the same company. So
Wow.
you might have a senior group of lenders that tries to prime a junior group of bondholders, and there might be some lawsuits going back and forth between them about who owns what collateral, or what's allowed or what's not allowed versus the legal contracts that they have, which are generally called indentures. Um, so there's a lot of risk, but if done right, it can certainly add value to, I would say, most portfolios.
Perfect segue, George. How should investors incorporate distressed debt in their investment portfolios? Obviously, bring in an expert like yourself, to help. But is it just like a core holding to their fixed income, or is it more of a hedge, more of a risk mitigator to an investment portfolio? How should investors look at it?
Yeah, I wouldn't necessarily call it a fixed income alternative. Although some of the biggest distressed debt investing funds have become so debt focused, and I think it's like style drift that they're only doing that. But I think distressed investing is an equity like strategy.
Oh,
It fits within your alternatives bucket in a portfolio, and I think most experts would say, for an investor, you should probably keep alternatives at somewhere between maybe 30% or less of your portfolio, sometimes a lot less, depending on the investor's appetite for risk, and sometimes a little bit bigger, maybe up to 40%, depending on the person's age and appetite for risk, or if it's a pension plan, what their outlook is in terms of their budget going forward. So that's alternatives. And distressed investing is a bucket within the alternatives bucket. So I would say for that, it should probably be no more than 50% of the alternatives bucket. But in an environment like we see right now, where the opportunity set seems to be great and getting even better, day by day, I would say you could grow that, and maybe it could be up to 50% of the alternatives bucket, maybe even a little bit above that. They say some of the best fortunes in the history of the United States have actually been made by investing in distressed situations. So, it should definitely be in every portfolio I recommend.
interesting. So when you talk about alternatives, obviously alternatives help reduce the correlation, increase diversification, bring that efficient portfolio, where you're getting more return for a reduced amount of risk, hopefully. Um, is that kind of the impact distressed debt has on investment portfolios also?
I would say so, yes. And I don't have a chart to show you, but I do believe that it moves a portfolio out below its efficient frontier because it provides really additional uncorrelated potential upside. Um, but within distressed investing, it depends on which manager you work with.
Mhm.
Our strategy, the way we've run it for years, is we try to um, generate returns both on the long and short side, up and down the capital structure of U.S. companies. And you can supplement that with, for instance, overseas distressed debt investing and things like that, or long only investing in distressed debt or private equity only. But I would say that generally, a distressed debt portfolio or a distressed securities portfolio can generate additional upside potential, especially like in a market like we see right now, where the equity markets are very choppy. Last year they were okay. Our portfolio crushed them last year. So far, in the first quarter of this year and into the first couple of days of May, I think we're up over 20% right now in our portfolio versus the equity markets are just sort of hanging in there. And there's a reason for that. We're long in the cycle. The S&P, the Nasdaq, the Dow, they've been driven to some extent by the biggest AI companies. Certainly with Nasdaq, and I think a portfolio of alternatives, especially distressed securities, I think can add to that and potentially take away some risk by adding additional diversification.
Fantastic, George. Such great information on really a fascinating space that probably doesn't get talked enough about. We talk a lot about alternatives on this show. A lot of it is more about REITs, private credit, private equity, that type of alternative. But there is a huge opportunity, yeah, in distressed debt that can help enhance a client portfolio. So I love it. Thank you so much for coming on, George. Is there any fun stories? I like to end the conversations. Any fun, interesting items that you've seen maybe in the industry over the years, or just maybe at Rutgers. It doesn't have to be industry related also.
Well, we started to talk a little bit about it before with these banks. I think keep your seatbelt tightened because, going forward, I think more and more banks, and we've looked at a number of them, through the first quarter reporting season now. I think we're going to see more and more zombie banks, with banks that, because interest rates have climbed so much, the value of their long positions in mortgages and other fixed income securities like that have really declined substantially. And I think a lot of them either don't get it or they just don't have the flexibility to write down the value of those securities, whether, again, it's mortgages or loans or long fixed income securities. And so the reason is that some of these banks, they just don't have a big enough equity cushion, to take a big charge to write down the value of some of those assets. And so I think you're setting up for an environment where you'll see zombie banks going forward, and some of them are unquestionably going to fail. They got too far, over the tips of their skis, I would say, and they could have avoided it with simple risk management rather than gorging on so much long dated fixed income during the bubble years. So, geez, I think a number of them, especially those that have, too much exposure to commercial real estate, they're facing trouble. And it's interesting, I don't know if it's a fun story, but, I'm hoping it doesn't become like a systemic meltdown. But in the meantime, there's some great opportunities to short sell some of those banks. And then later, if they get taken over by the FDIC or get restructured, sometimes there's opportunity to buy those same assets that those banks had at a fair or reduced price, because some of the companies that come in to acquire them, whether it's JP Morgan or UBS, which bought Credit Suisse, or First Citizens, which bought Silicon Valley Bank, some of those present some interesting opportunities going forward.
Interesting. And then you mentioned it earlier with the inverted yield curve, banks, their revenue stream is hindered too because that inverted yield curve, it doesn't give them the benefit to lend out money right now when it costs more to borrow, right?
That's right. I mean, when you have an inverted yield curve, it basically shuts down banking. I mean, it makes banking nearly impossible. That's why it's such a good predictor of the future of risk of recession in an economy. When most banks are facing that kind of sort of existential crisis because they can't make new loans, for long paper, and they have to pay their depositors more, they're upside down. And
Mhm.
eventually it causes the whole economy to slow down. So that's another interesting thing, by the way. We've had this for a while, but so many investors in the fixed income market have said, oh, well, it's temporary. Powell will surely reduce interest rates soon, and nobody's fearful of recession anymore. But I think that's a little bit of an oversimplification too, because, I think we're approaching the time now when the impact from higher interest rates really starts to kick in terms of the lagged effect on an economy.
Mhm.
And, for those that expected interest rates to suddenly drop again, I think Powell and the Fed, they wish they could, but, there's just too much inflation, and they built up their balance sheet way too much during COVID. So the flexibility of the tools they have has been sharply reduced. Um, so it might sound a little bit like I'm trying to talk up my book about distressed investing and the opportunity set, but I truly believe that economy wise, it should be a massive cycle. And I think, you can see it already in terms of what we've seen in the market. Last year, in fact, was the fourth busiest distressed year ever reported by JP Morgan. And I think going forward, you'll see a lot more of it.
Interesting. That's an interesting nugget to end on. Fantastic. George, where can our audience get more information on Schultze Asset Management?
Sure, they can just call us. They can call us at 914-701-5260. We're also on the web, or they can email us at investorrelations@samco.net or info@samco.net. We'd be happy to chat with them.
Fantastic. George, thank you so much for coming on the show. Really was an honor. Thank you for sharing such great insight on a fascinating space. I really enjoyed it.
Thank you,
Thank you,
Ryan. It's great to be here.
everyone, for listening to this episode of Zephyr's Adjusted for Risk podcast. You can watch all of our podcasts on the Zephyr YouTube channel, as well as on Spotify and iHeartRadio. Thank you and have a great rest of your week.